Thanks for watching the Multi-Billionaire Empire Framework Series. This is tax benefits for multifamily, multi-unit, and commercial real estate. Basically, just going to give you an idea of the tax benefits and how much money you're really going to end up with at the end of the year. So you have a rule of thumb and an idea. So, these principles and concepts apply to all your commercial real estate. I'm not a real estate accountant, but I have an excellent one, probably the best one in the industry. But this will give you the idea and let you know what is possible and what you're really looking at. So, for example, on $1 million property, similar to ones we've been talking about, if you have one and we paid $200,000 down, which is the worst case in the world scenario, because normally I can get you in zero money down on even bigger stuff. 10% down would be like on a bad day, but normally it's, if you listen to what I'm saying and we do it the right way, first off, we're going to be getting cash back versus down payments. But for the sake of the experiment and the tax purposes to find out what the real money is and the cost for taxes, this is a good example to show you. So, because all your cap rates are based on cash only properties if you own them free and clear. So, this is for like the normal worst case scenario. With $200,000 down with the 8% cap rate, which is not that great. I mean, it's okay. But for buying it, maybe just right. So, you have depreciation benefits. So, with a profit of $80,000 a year on your net operating income, all you have left is your loan payment. So, on a loan payment, for example, at 4%, your payment over the year will be $45,832, and that is made up of a principal portion and an interest portion. Of course, most of your payment is going to interest. Depends on how the loan's set up and at what point you're in the loan, for if you're on an adjustable rate or if you're in it to begin with on hard money. Either way, this will leave you with the cash for the year that is taxable. So, how much money of that are you going to retain? In apartments, you get to depreciate them over 27 and a half years thanks to the IRS, and you get to do that off of the value of the building. Since the value of this building is $1 million, you get to depreciate 80% because 20% of it they're going to count for the land, which doesn't really count. So you have $800,000 depreciable over 27 and a half years, which gives you $800,000 divided by 27 and a half years gives you a total of $29,090 a year to depreciate. So that's coming off the profit, so you don't have to pay taxes on that, which is good news. So you can also depreciate out your principal payment, which is $14,000. Actually, it's called, well, that is part of your profit. So you got $14,000 plus your $34,000 cash for the year. So minus depreciation of $29,000 leaves a taxable gain positive of $19,166, which you would be paying taxes on. But on your cabinets, cabinets, appliances, and carpet, and your basic building upkeep things, is called accelerated depreciation or cost segregation, and allows you to accelerate the depreciation on those things. It's a different equation, but for the most part, on average, it would be around, on this scenario, it'd be like $10,000. So now you're broken down to like a basic total taxable amount of $9,166 to be taxed on. And now if you're in the worst case tax bracket of like 35%, you're only paying taxes of like $3,200 on $1 million property, which is barely nothing. And if you have a good accountant, it could be even lower than that, or you can even show a loss. So this is how you have one property to 100 properties and not pay much for taxes, and you're writing everything off, and you're making tons of money on the cash and your equity buildup. So that scenario, if you want to apply it to a $10 million property, you're basically worst case scenario on this example. These are small. It's not, I mean, a lot of things make a lot more money than this scenario, but I'm just giving you an example for the taxes. So, example, on a $10 million property, say for a $340,000 profit, the estimate on the taxes could be like $32,000, or that with a bad accountant. So you're still making on one property, you still cleared like $310,000. And if we get you to close your first deal, then you'll know how to do it, and we'll be able to have cash to allow you to have leverage to close more properties. We'd be closing properties once a week, building up net worth. Now, if we did this is just basic rule of thumb, or if you did it on a $20 million property, you make $3.4 million net a year after payment and everything else. You're looking at a tax of like $300,000, and you're clearing basically $3.1 million just on one property. These are low numbers, and a lot of properties make more money than this. But if you have a portfolio, you get one, and you're buying like 5 to 10 a month. Even if you're slow, like 4, you're making bank. I mean, it's easy in a year to have up to $100 million in real estate. Easy. So that is your simplification of taxes. So overall, you have like you have your regular depreciation over 27.5 years on 80% of the whole property value, not the price, but the value of the property, minus the land of 20%. So you have that portion. You get to deduct or accelerate out your inside appliances, basically your depreciable things that do not last as long. And that's a different calculation, but that adds up to be about 10,000, maybe 10% per property. And if you do that in your tax bracket, you have regular depreciation and accelerated depreciation, and then in your tax bracket you have it down to like $3,200. So even on, I mean, that's like 3% is what taxes are really end up being for the IRS if you do not have a good accountant, and that's just standard stuff. So that covers like why building wealth through apartments is so important, at least on this portion. And then you could get into other things, shopping malls and hotels, which is different. But that kind of goes over how much taxes you'll be paying and how much money you're going to be netting actual cash in your pocket at the end of the year. So it definitely pays to get into commercial real estate. Apartments first. All right, thanks for watching.